Tesla stock has been on its worst run in the past few years, and most investors are jumping ship. But today, it'll be breaking down why it just might be time to buy.
You're watching Trade Daily. Like and subscribe for more daily Tesla stock market news.
Tesla has taken the auto industry by storm and has single-handedly taken electric vehicles mainstream. Forced with the decision to change or get left behind, legacy automakers are now racing to put out their own EV models, challenging Tesla's control of the future of the industry. As a stock, Tesla has been a huge winner in recent years, though bears have always roared loudly, convinced that the company is overselling its future technology and that CEO Elon Musk isn't a trustworthy leader. Is Tesla stock a buy today? To answer that question, we asked a bull and a bear to debate the subject. Jeremy Bowman, a top market analyst, says Tesla created the market for electric vehicles and still dominates it today in the US, while the company will face increasing competition from both legacy competitors and pure-play EV companies like Rivian and Lucid Group. It will take time for those companies to ramp up production, meaning Tesla should continue to lead the EV market for the foreseeable future. In the first 3 quarters of 2022, 65% of the 525,000 electric vehicles registered in the US were Teslas, and it owned 86% of the luxury EV segment. Second place in total EV sales was Ford, with just 7%. In other words, despite the hoopla over its emerging competition, Tesla is still leaps and bounds ahead of its competitors. Tesla's Model Y and Model 3 were the leading EV in Europe through October of this year, and the company retains a significant presence in China, the world's largest EV market, but one in which consumers tend to prefer cheaper EV. Tesla's track record of execution and wide profit margins should also give investors confidence going forward, as the company turned in an operating margin of 17.2% in the third quarter. The company also intends to increase production annually by 50% over the coming years, and if it can achieve that, investors should expect similar growth in revenue and profits. Finally, Tesla stock is trading at its lowest earnings multiple ever after a steep slide over the past few weeks, as investors have been frustrated by Musk's adventures at Twitter. If he can allay that concern and the company can deliver a strong fourth quarter, Tesla could begin 2023 with a strong rebound. Other top analysts like Parkev Tevoshin said my bear case for Tesla centers on its expensive valuation. Tesla's stock is trading at a price-to-earnings ratio of 42.66, a multiple higher than General Motors, Ford Motor Company, and Toyota. These are car companies with decades of experience building and selling vehicles. Sure, Tesla sells only electric vehicles, while the others sell gas-powered and electric-powered cars. And Tesla is growing much faster than the competitors mentioned above. Tesla's compound annual revenue growth in the last decade was 74.6%. However, this came at a time when Tesla had limited competition in the EV industry. As several rivals have entered the fray, consumers have plenty of options when buying an EV. This is double the bad news for Tesla. First, customers shopping for an EV will buy a model that is not a Tesla more often than in years past. Second, competitors are buying up the materials that Tesla needs for its production, raising Tesla's cost of goods sold and constraining units produced. All this would be fine, and I suspect Tesla will be among the leaders in the EV industry for several years, but this is not a company I would want to pay a significant premium to buy. For Tesla to sell more expensively than the legacy automakers is reasonable, but trading at more than 4.5x the P/E ratio of Toyota and 8.0 times that of Ford is a bit much. The bear case for Tesla gets stronger and stronger, as it has been reported that Tesla has suspended production at its Shanghai plant on Saturday, according to an internal notice and 2 people with knowledge of the matter, bringing ahead a previous plan to pause most work at the plant in the last week of December. The U.S. automaker canceled the morning shift and told all workers at its most productive manufacturing hub they could start their break, said the people and the notice seen by Reuters. The company did not give a reason. Reuters reported earlier this month that the electric car giant planned to suspend Model Y production at the plant from December 25th to January 1st. The suspension comes among a rising wave of infections after China eased its zero-COVID policy earlier this month, an abrupt move welcomed by businesses and the public, but heavily disrupting business operations in the short term. One of the people said workers at Tesla and its suppliers have also been falling sick as part of this wave, posing challenges to operations in the past week. Tesla is also grappling with elevated inventory levels as its second-largest market braces for a downturn. The Shanghai plant has been focused on making models for export in the last week, the person added. A media representative at Tesla China did not immediately respond to requests for comment. The plant's suspension of Model Y assembly at the end of the month would be part of a cut in plant production of about 30% in the month for the model, Tesla's best-selling model, at the Shanghai factory, Reuters had reported. The Shanghai factory, the most important manufacturing hub for Elon Musk's electric vehicle company, kept normal operations during the last week of December last year. It has not been an established practice for the plant to shut down for a year-end holiday. But even with this news, I'm still very hopeful for the future of Tesla. This is why I'd like to give you my top picks for Christmas time stocks. Yes, these stocks each offer something even Santa would like. Santa's known for making lists and checking them twice, and that's a great idea if you're an investor. It's important to create a watch list and survey those stocks for potential buying opportunities. Of course, we don't know if Santa is an investor, but if he were, he probably would put a certain kind of stock on his nice list. Santa would favor stocks that keep on giving over time, such as those with dividend growth. Understanding as he is, Santa would scoop up shares that have declined this year if the companies demonstrated earnings strength that could power future growth. Let's check out 3 Santa-style stocks to buy before 2023. My first pick will be Home Depot. This stock falls into the category of companies with shares that have dropped even as earnings advanced. The world's biggest home improvement retailer is heading for a 24% loss this year. This has left Home Depot trading for about 18 times forward earnings estimates. That's down from more than 24 earlier in the year. At the earlier level, Home Depot was a buy. At today's level, it's a steal. The company has continued to grow revenue and profit, even in today's tough environment. In the most recent quarter, all of the company's 19 U.S. regions posted positive comparable sales growth, and 11 of the 14 merchandising categories reported positive comparable sales growth too. Return on invested capital has dipped somewhat this year, but has remained high over time. This indicates the company is benefiting from its investments. Importantly, Home Depot's 2 customer types, the do-it-yourselfer and the professional, remain healthy. The pro customer is a particularly good guide for what may happen in the future. Their backlogs offer us clues about project volume, and pros are telling Home Depot backlogs are strong. All of this makes Home Depot a great buy now, and one that could deliver big over the long term. Second on my list is Abbott Laboratories. Abbott Laboratories, up 0.14%, is a stock that will keep on giving. The healthcare company is a dividend king and has raised its dividend for at least 50 consecutive years. Why is this good for you if you're only investing in Abbott as of now? It shows dividend growth is important to the company, so it's likely it will continue to boost its dividend over time. And the company's earnings growth indicates it can afford to do that. Abbott has grown revenue, profit, and free cash flow over time. In the most recent quarter, Abbott reported sales of more than $10 billion and raised its earnings per share guidance for the year. The company has 4 business units: diagnostics, medical devices, established pharmaceuticals, and nutrition. 3 of them have increased sales over the first 9 months of the year. The advantage of having 4 distinct businesses is that when one of them sees a decline in sales, the other units may compensate. For instance, a baby formula recall weighed on the nutrition business this year, but regulatory approvals in the medical devices unit helped that business to compensate. Abbott shares have declined 24% this year. That leaves them trading at about 20 times forward earnings estimates, a reasonable valuation for a company offering passive income and earnings growth over time. And last, but certainly not least, Tesla. Tesla is heading for a 60% decrease this year. Why have investors turned their backs on the electric vehicle EV giant? They've worried about the impact of today's tough economy on the company. After all, higher interest rates are increasing costs, and currency exchange rates are weighing on the value of sales. These problems won't disappear overnight, but it's important to take a long-term view when investing in stocks. That means looking at a time frame of at least 5 years. And from this angle, the Tesla story still looks bright. Even in today's difficult environment, Tesla has managed to report record revenue, operating profit, and free cash flow. The company is ramping up operations at 2 huge new factories and has grown vehicle deliveries in the double digits. Tesla also remains the leader in both the regular US EV market and the luxury market. All of these factors are reasons to be confident about Tesla's prospects over time, especially considering the stock's current valuation. It's trading at 33 times forward earnings estimates, down from more than 80 earlier this year. Considering Tesla's leadership and future potential, the stock is a steal right now. Some of you may be seeing the stock drop rapidly and wonder why. Well, I break down everything that's going on and why the stock price is crashing right here.
Thanks for watching this video, and remember, this is news and entertainment, not investment advice.